Ladies and gentlemen, good day and welcome to the Vaibhav Global Limited Q2 and H1 FY26 earnings conference call. As a reminder, all the participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Nishita Bhatt from Adfactors PR. Thank you, and over to you, Ms. Bhatt.
Earnings conference call for second quarter and half year ended 30th September 2025. Today, we have with us Mr. Sunil Agarwal, Managing Director, Mr. Nitin Panwad, Group CFO, and Mr. Prashant Saraswat, Head of Investor Relations. We will begin the call with operating remarks by Mr. Sunil Agarwal on the business operation, key initiatives and broad outlook, followed by the discussion on financial performance by Mr. Nitin Panwad, after which the management will open the forum for the Q&A session. Before we get started, I would like to point out that some statements made or discussed on today's call may be forward-looking in nature and must be viewed in conjunction with the risks and uncertainties that we face. A detailed statement and explanation of these risks is included in the earnings presentation, which has been shared with you all earlier. The company does not undertake to update these forward-looking statements publicly. I would now like to invite Mr. Sunil Agarwal to make his opening remarks. Over to you, sir.
Thank you, Nishita. Good evening, everyone, and thank you for joining VGL's Q2 FY26 earnings call. I hope you have reviewed the results and investor presentation. We are pleased to report another strong quarter with revenue growth above our guidance range and strong PAT growth despite macro headwinds. The September quarter also marked a period of operational stability across regions, supported by efficient inventory planning and improved execution. We reported consolidated revenue of 877 crores, reflecting a 10.2% YOY growth. Gross margin stood strong at 63.5%, well within our target range of 60% plus, owing to strength of our vertically integrated global supply chain. This structure enables cost efficiency, operational flexibility, and industry-leading margins, a differentiator which none of our peers have in place. On the digital side, momentum remained steady, with digital contributing 42% of B2C revenue. We remain on track to achieve 50% sales contribution in digital by FY27. Let me briefly cover our regional performance. During quarter two of the financial year, total revenue in US dollar terms for US and UK recorded a growth of 6.7% and 5.7% respectively, while Germany remained flat. In US, we addressed tariff uncertainties by pivoting to casting process in US and procuring parts of the input from US. This was made possible by leveraging over 4 decades of manufacturing learnings in India. This integrated model provides cost benefit and requisite agility for our operations. Aided by advanced inventory shipments made in Q1 FY26, positions as well for the festive season. In the UK, the business continued to consolidate its position, supported by a strong management bandwidth and portfolio synergies between TJC and Ideal World. Wage growth outpacing inflation also aided spending recovery in UK. We are pleased that Ideal World is very well assimilated with TJC and is now churning a low single-digit EBITDA margins. We are confident of achieving double-digit EBITDA margin within 2 years. In Germany, while revenue remained broadly flat, we achieved a healthy expansion of nearly 410 basis points in gross margins, driven by a sharper product mix and a stronger pricing discipline. The TV channel sustained its positive momentum, growing 6% in the first quarter. Digital revenue, however, declined 9% owing to team realignment. We are confident of delivering EBITDA breakeven for the full year FY2025-26. We continue to focus on the four pillars of our growth strategy, namely widening reach, new customer registration and acquisition, customer retention, and repeat purchases. In the Q2, our TV network reached 127 million households. As of 30th September 2025, our unique customer base stood at 714,000, up 5% YOY, and the highest in our history. New customer acquisition was 380,000 on TTM basis, while the retention rate remained stable at 41%. On the TTM basis, customers purchased an average of 22 pieces. Sustainability remains integral to our operations. Our ICRA ESG rating was further upgraded to 73. This reaffirms confidence in our governance and execution capabilities amidst dynamic macro environment. With Germany now certified as a great place to work, VGL Group is now Great Place to Work certified across the globe. Under our Your Purchase Feeds program, each unit sold funds a meal for a school-going child. We are pleased to have served 160 millionth meal this quarter, currently providing about 55,000 meals every school day. We continue to strive towards our goal of serving 1 million meals per school day by FY40. On the clean energy front, we generated 1.2 million kilowatt hours of solar energy during the quarter, meeting 100% of our manufacturing power needs. We are advancing towards our goal of achieving carbon neutrality under Scope 1 and 2 by 2031. We remain focused on creating long-term value for stakeholders. Thus, the board has declared second interim dividend of Rs 1.5 per equity share, implying a 53% payout. We are pleased to have delivered revenue growth slightly above the guided range of 7 to 9%, which was supported by efficient execution and robust supply chain. In the medium term, we are confident to achieve mid-teens revenue growth with steady improvement in operating margins. Finally, I will say that while external risks persist, our balance sheet remains robust and we are well positioned to sustain our profitable growth momentum. I will now hand over the call to Nitin to discuss financial performance. Over to you, Nitin.
Thank you, Sunil. Good evening, everyone, and thank you for joining Q2 of Financial Year 26 earnings call. I will now walk you through the financial highlights. As Sunil mentioned, we stayed watchful of market trends and managed our operation with agility. Consumer demand across major markets was influenced by changing spending patterns and continued tariff and geopolitical uncertainties. Consolidated revenue for the quarter was Rs 877 crores, which is up 10.2% year-over-year, reflecting growth higher than our guidance despite an evolving business environment. During Q2, the total revenue in US dollar terms in US, UK recorded growth of 6.7% and 5.7% respectively, while Germany remained flat. In the US, the uptick was driven by proactive inventory planning supported by our in-house manufacturing capabilities. The performance was further enhanced by a strong traction in digital business, which is now contributing 42% of sales in US versus 39% in last year. We believe that the digital first and vertical integrated model like ours are favorably positioned to capture long-term growth. In addition, during the quarter, we began jewelry casting operation in US and also started sourcing key metals locally. This approach helped us to navigate tariff-related challenges effectively while keeping our supply chain advantage intact. In the UK, TJC regained growth momentum supported by strong merchandising and operational efficiency. Ideal World continued to make a positive contribution to profitability, Ideal World has already achieved a low single-digit EBITDA margin and is on the course of achieving double-digit EBITDA margin in the next 2 years. In Germany, we have improved our gross margin by 410 basis points year-over-year in past quarter, supported by a better product mix and pricing discipline. The TV business continued to grow 6% in first half of the year. However, digital revenue declined by 9% owing to team reshuffling there. We have now fortified bandwidth of digital business with the requisite talent. With continued focus on margin enhancement and cost discipline, we expect Germany operation to achieve EBITDA breakeven for full financial year FY2025-26. From the sales platform point of view, TV revenue stood at 487 crores, up 6.7% year-over-year, while digital revenue grew 14.3% year-over-year to 336 crores, reflecting continued strength in omnichannel performance. Digital now contributes 42% of overall revenue, and we remain on track to reach 50% by FY27. Lifestyle products accounted of 36% of total sale, up from 12% of FY18, with a medium-term target of 50%. The budget pay program continued to contribute meaningfully and is at 38% of our total B2C revenue. Gross margin stood firm at 63.5%, consistent with historical trend and supported by our vertically integrated model. Achieving a margin of 60% plus, even in one of the most dynamic and challenging business environment, reflects structural strength of our unique business model. EBITDA margin improved by 130 basis points to 10% and is up by 28% year-over-year in absolute terms. The EBITDA margin expansion was driven by productivity improvement and operating leverage in employee cost, which shows 160 basis point improvement. Shipping cost shows 30 basis point improvement year-over-year, and maritime cost shows 40 basis point improvement year-over-year. As a result, PAT increased by 71% year-over-year to 48 crores. Our unique business model continued to generate steady cash flow for us. Some parts of our cash flow were cautiously invested in inventory to address tariff-related uncertainties. Even after this adjustment, we generated 66 crores of operating cash flow and 55 crore of free cash flow. The balance sheet remains strong with 156 crore of net cash, reflecting prudent financial management and strong liquidity position. ROCE at 20% and ROE at 13% indicates continued improvement in returns. The board has declared a second interim dividend of rupees 1.5 per equity share, representing a 53% payout, consistent with our commitment to reward to our shareholders. While the external environment remains dynamic, we continue to take calibrated approach to growth. We are maintaining our FY26 revenue guidance at 7 to 9%, supported by operating leverage. We remain confident that the resolution of tariff-related and macroeconomic challenges over the time could create upside in this range. Over the medium term, we continue to aim for mid-teen revenue growth along with operating leverage. Thank you, and over to you, moderator. We may now open the lines for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Shreyans Jain from Swan Investment Managers. Please go ahead.
Hello, good evening. Congratulations on a good set of numbers. So my first question is, if you could help us understand what would have been the constant currency growth for the three geographies, specifically US, UK, and Germany. I think that slide is missing from this quarter's presentation. So can you just help us with that first?
Yeah. Hi, Shreyans, Nitin here. So constant currency growth is around 5.5% for the current quarter.
No, Nitin, I'm asking specifically for US, UK, and Germany, or maybe if you can
Okay,
help me
US.
with the actual
Sure.
currency the actual revenues that we would have done in dollars, pounds, and euros.
Sure. So US is 6.7% growth year over year, and UK constant currency growth is 4.1% year over year.
Okay. All right. And my next question is, sir, when I'm looking at your segmental numbers, this quarter, obviously, we've started doing some of the casting in the US itself. But when I look at your India and the ROW, where essentially our manufacturing operations are based out of, when you look at the profitability has gone up significantly, from 33% last year in India, it's gone up to 50%, and ROW from 38.5 to 55%. So what is actually transpiring? What is happening in these two geographies, sir? And second part to my question is, when I look at US, UK, and Germany, which are essentially three operating geographies, our absolute EBIT has not increased, say about 5-6 crores increase in these three geographies. And it's only because of India and ROW that we see the EBIT increase of, say, about 20 odd crores. So can you just help us understand, because there's a lot of confusion there.
Yeah. So I think we will share with you separately.
Your voice is cracking. I can't hear you.
Is it better now?
Yes, sir. It's
Yes.
clearer now.
Yeah. So detailed working.
Sorry to interrupt,
you
sir.
again,
Your
Nitin.
voice is still cracking. Ladies and gentlemen, thank you for patiently holding. We have the management back in call, and Mr. Shreyans, you can continue with your question.
Yeah. Hi, Shreyans. I'm not sure how much you heard, but the detailed working Prashant will share with you that UK and India both profitability comprising the dividend income of their parent companies, which is subsidiary companies, which is US. But the detailed profitability Prashant will share with you. In UK, there's a significant improvement in the profitability from to.
So we lost you again.
You're cutting up again.
Sorry to interrupt, sir.
Nitin, we
Your
lost
voice
you
is
again.
cracking again.
Is it?
Just a moment, sir.
Repeat from UK again.
Sir, can you speak a sentence now?
Yeah. Thank you, Sunil. Good evening, everyone, and thank you for joining.
Yes,
Is it
sir,
audible?
you can continue. Yes, sir.
Yeah. Okay.
Yeah.
Yeah. So, yeah, sorry for the interruption. Somehow there's a network issues here. But the Shreyans, I was just mentioning that Prashant will share the detailed profitability with you. The improvement in the number you see in the segmental reporting includes the dividend income in UK and India, which Prashant will share with you separately. But in terms of operational profit, there's a significant improvement in UK, US, and the Europe operation in all of our retail entities.
Okay. And sir, second is, US profitability. Obviously, you're saying it's improved, but I'm just looking at the last 4 quarters, the trend in the profitability of US. So margins from 11 had come to 7, 6.8, and then now 5.2. and US obviously 60% of our business, right? So how should we look at the profitability of the US business? And my last question, sir, is some sense on Germany, if you can help us, because we were understanding that we had spent a lot to actually premiumize your OTA lines and improve your customer set, but obviously Germany has been a little weak in this quarter. And last is, sir, there is some volume and value degrowth, so TV sales ASPs have gone down by 6 odd %, and on the digital side, our volumes have gone down by 2 odd %, whereas ASP has increased by 10%. So just some sense on what is happening in each of the TV and digital categories.
Sure. So first in US profitability, so US has a growth of 6.7%, and we have invested the money mainly in our digital marketing, where we have done our investment in OTT apps like Roku and also the digital platforms like AppLovin. So being this quarter compared to last year, around 10 basis point in our margins in in US from 5.1 to 5.2% compared to last year same time. But obviously that Q3 is a significant quarter where we generate a high single digit to double digit profitability in our retail operations. In terms of the in Germany part, so Germany past quarter we have seen the slowness in terms of especially the sales in digital part, where we have done a reshuffling in the team related to the lower conversion and traffic issues that we have seen internally in our platforms. So that we have already done the changes, and we are seeing the returns are better compared to the previous quarter we have seen, and we are confident that the Germany will profitable in the next 2 quarters. So we will make a full year profitable in the Germany operation. Especially the major improvement we have done in Germany in terms of gross margin side. Gross margin was improved around 410 basis points year-over-year in Germany, related to better pricing and the product mix that we have offering to the end consumers. And you mentioned about the price point of TV and web. So price point is more driven by the consumer demand, what consumer is looking for, and we keep on offering to the consumers a different set of products. So not necessarily that number will specifically drive the consumer traction. It is because of 30,000 different SKU portfolio. Volume growth is not directly linked with our sales. We offer based on the consumer requesting. Like last year, we have seen a pretty good response from the gold and the lab grown side also. That resulted the higher ASP, but we have seen the growth in our absolute ASP. The similar in range in this quarter, we also seeing the traction towards the fast fashion jewelry, which is resulting the higher volume growth. But we offer what consumer is looking for within the trend and the fashion in the respective territories.
Thanks. Sir, I'll get back in the queue for more questions. Thank you, sir, and all the best.
Thanks, Jan.
Thank you. Our next question is from the line of Lakshmi Narayanan from Tunga Investments. Please go ahead.
Yeah, thank you. Few questions. Just want to understand what is the half year EBITDA loss in Germany, and what is the plan? I mean, how do you think this year would actually end? The second question is related to profitability. I see that we have actually maintained a healthy profitability. Is there any one-off that actually resulted in it, or what activities we have done to ensure that the profitability is high, and therefore do you expect the profitability to be maintained at these levels? And the third question is that you had actually mentioned lab-grown diamonds sales have actually are almost double digits. So I just want to understand what is that percentage now, and are we getting higher margins from those products? I think these are my 3 questions.
Thank you, Lakshmi. Let me answer your initial questions. So Germany first half loss, EBITDA loss is roughly around 700,000 euro, and that will be compensated in coming quarters with the improved margins that we are seeing in gross margins and also improving in our digital contributions. The second thing is the profit. There is no one-off adjustment in the profitability. It's just a purely operational performance, and this is helped by in our mainly operating leverage improvement in revenue, and also reviving the Ideal World operation, which was making losses in past many years, even before the acquisition. Now that business is resulting profitability to us, contributing positively in bottom line. The third part is the lab-grown diamond. We started that business, I think, in 18 months back. So since then, that category is growing pretty well for us. Last year, the share was around 5.5% for this business, and now it is almost 10.3% of our total sale that business. And we continuously seeing consumer traction towards the lab-grown diamond, and that we are continue to offering in our all three territories.
Sir, on the profitability, why do you think this is something which can be is maintainable at these levels for this year?
Certainly, that is possible. That we are seeing that the higher gross margins, despite the tariff related hits that we have in US, we managed to pass on the pricing to consumer. Now with the casting process that we have started in US, that will result in terms of better of pricing compared to the competitors who don't have that kind of ability, and that may give us a ability to take a higher gross margin from the consumer. So that part will cover off in terms of the profitability, and we are pretty confident with the process that already been started and some of the shipments already been tested successfully. So we expect that some of the margins we can pass on to the consumer, and some of the margins we can also get in our profitability.
Another thing, this is Sunil here. Another thing that is helping us is the lower employee cost, some process automation, some LLM AI benefits. We are seeing the employee cost to be lower, and that will continue to go down in Operator?
Does that answer your question, Lakshmi Narayanan? I think we have lost the line. I will take the next question now. The next question comes from the line of Pritesh Chheda from Lucky Investments. Please go ahead.
Sir, I couldn't hear. Did you quantify the H126 half-yearly German loss, EBITDA loss?
Yeah, so half-year Germany is a EBITDA loss, but the company that will compensate against the H2 of the performance in season time and the last quarter of the year.
Yeah, Nitin did quantify that. Nitin, can you quantify again?
Yeah, so the losses was around, so EBITDA loss for the first half of the year, this year is around 700,000 euro.
0.7 million euro. And you are saying that
700,000.
The 700, so that's 0.7 million euros, right?
Yeah, right. Yeah.
And you're saying that the H1 loss and the H2 profit will nullify each other. So it will be a neutral year. It will be a neutral year in FY26.
Right.
And how was it in H225? Was there a loss in half year last year in Germany?
Yeah, it was break even the last year. Last year was break even.
Achha. The other thing is, from the presentation I couldn't figure out your original properties, your baseline properties of Shop LC and TGC UK.
Yeah.
At what rate those two assets grew? Because what we now see is the segmental, which is US and UK, and then there is one more channel being bought in UK. So if you could just clear that for us in quarter 2 and H1, what was the growth?
Sure. So quarter
the presentation
2
doesn't carry it. The presentation doesn't carry, that's why,
Sure. I'll ask Prashant to separate that also, share separately. The US grew by 6.7% year over year, and UK grew by 4.1% year over year in GBP.
So this is in the TGC UK.
Yeah, UK, combining Ideal World and TGC both.
Ideal World and TGC. And with the Mindful and the other two properties, UK is a 10% growth, right?
Yeah, Mindful and the properties are separate. It is coming in under the Europe, so that is separate. But the major territory US UK is 6.7 and 4.1.
The Europe. Okay, so there you have put it. So then, if what I see is a 10%, okay, there is a what you mentioned is 4.7 GBP growth. So then there's a rupee depreciation, and there's a rupee depreciation and the reported growth. Okay.
Yes, rupee depreciation also.
Okay. Can you give, so then for the 10% growth that we see YOY, what will be the constant currency growth for quarter 2 and H1?
So quarter 2 is 5.5% growth in US dollars in our retail units.
5.5.
Yeah.
Okay. Any reason why we are not seeing the profitability improvement happening in the US business? What is the key areas that one should look at? Because US business, the margin that it was and the margin that it is a significantly different number. So if you could just highlight that.
Sunil, would you like to add on it?
Yeah, sure. So US, we believe we've invested more in digital customer acquisition through OTT as well as digital properties. So there's a new social media called Applovin, the video game people play Solitaire or Candy Crush. In those change of the games, there are ads coming. So we invested in that platform quite a bit in last couple of quarters, and that also impacted our profitability. But that's an investment to understand the platform and to acquire customers from that platform. And OTT, especially Roku, we invested quite a lot of money into app downloads, and we had over 500,000 app downloads in last quarter. So that gives our brand visibility and customer acquisition as well. But from people point of view, we had the benefit of HR cost benefit and airtime benefit in overall for the group. But digital expense was higher.
Okay. So basically, US went through the cycle and continues to be in the investing cycle where you first bought some cable homes, then you added digital spending, then now you're highlighting this gaming publishers where you are putting up your ads, and then the OTT. So basically, in a 3-year phase, you've been continuously putting up one or the other investment. How should we look at this US business now? So every time there is a new reinvestment which is done. So if you could just call out that.
Yeah, so as we guided, we will grow 7 to 9% with the leverage and profitability, and that leverage will come combination of US, UK, and Germany, all 3 geographies.
Okay, can you call out the margin expansion now possible from what you're reporting at a single-digit number aggregate, since your answers are also aggregate? So the margin number, which is let's say about 9%, which we are seeing, directionally where they should head to?
Yeah, so EBITDA is right now around 10% for this quarter. We expect this to further expand in current Q3 as well as Q4.
That is a seasonally higher quarter. On an annual basis, if one has to look at a 9% number, X other income, this X other income 9% number on an annual basis, next year or year after where it should head, and considering the strategy that you put in place.
So we don't give specific guidance on the margin, but we do expect that the margin would expand higher than the revenue growth. So we're giving 7.7 to 9% revenue growth for the current year, and the margin would expand higher than that year over year. Now, since the economy is pretty dynamic, especially with the tariff expanding or shrinking, and we finding solutions around them, very difficult to give specific guidance. And also, as you rightly mentioned, we are making investment in different areas. So specific guidance is difficult, it's because it's dynamic, but we expect to have a leverage or decent leverage for the year as well as for coming year.
Okay. My last question is on these tariff issues and whatever tariff, how looking at the margin number, looking at the growth number, you're fairly mitigated it. So if you could just throw some light of the avenues of these mitigation.
Yeah. So what we learned, in US, 80% of our business is jewelry, and of that 80%, about 75-80% is silver, gold, or platinum. For that, we've done the castings from third parties in US, and those castings were bought in to Asia for finishing and studying with the stones. And if the original major portion of jewelry is made in US, the reciprocal tariff is not applicable on the value addition. And when the casting is US made, there is no tariff. There is zero tariff on the casting portion of itself, which used to be 5.5% earlier. So all in all, our cost, the tariff cost comes to below 5.5%, which used to be pre-reciprocal tariff.
Okay. Thank you very much.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address the questions from all the participants in the conference, kindly limit the questions to 2 per participant. Should you have follow-up questions, please rejoin the queue. Our next question comes from the line of Deepesh from Manya Finance. Please go ahead.
Yeah, hi. Am I audible?
Yes, sir.
Yes, Deepesh, go ahead.
Okay. Just wanted to know how many shipments have we done with this casting tariff experience, and we have paid only 5.5% tariff. How many I just want to know how many test shipments have we done, and whether that over a longer period of time will be applicable.
Yeah, so multiple shipments. So I don't have exact number, but maybe I think 10 shipments already gone. And this is so far the casting has been done by third party, but we have set up our own casting operation. Should be operational by about 15th of November. All the machines and all the permits have already been received. Now the installation is going on.
So how much capex have we done on this?
Not too much, because capex on casting is not substantially high. It's fairly limited. But it is the manpower, the know-how, and the process that is the crucial element.
If you can just quantify how much has been the investment in US which we have done for this specific thing.
Do you have a number?
See, less than $500,000, and also not a significant amount of manpower is required in US. Machinery process and the setting up the machinery is less than $500,000.
$500,000.
Less than $500,000.
Great. So this will just to understand that when we mentioned that we will not be able to quantify how much our margin expansions because of the tariff. Of course, if the tariff reduces, the margins will vary. But just wanted to understand this being a very significant factor because most of our revenues come from US. Most of our jewelry manufacturing is done. Most of our sales come from jewelry. So even if the tariffs reduce, let's say even 15% or even 10%, still because of this the arrangement of casting which we are doing, how much do you think that the sales of your entire jewelry thing will be done by this casting unit, and we will be using that and significantly increasing our margins because this will be at least that the entire tariff will come to our margins, right?
It depends on the environment. If the competitors get the products from their supplier, because there's no other vertical retailer who does manufacturing themselves, but they are sellers to those retailers. If they themselves have the same process of casting done in US and then make the jewelry in India or China, wherever, can save the duty also. So it'll be dynamic environment, the competitive environment. We'll try to maximize as much as we can, but it still is very dynamic.
Okay. No, because if we had done the shipments, I mean, in the entire quarter, I was not able to understand, why our margins from US were significantly lower, because we actually got a tariff advantage of around 50%. Even if we have passed it on to the customers, still, there would have been a significant advantage in terms of the competition.
So it's not necessarily that all the other players are paying 50% and then importing into US. There are differential tariffs in different countries. For example, Thailand is 20%, or Dubai is 10%, or UK is 10%, or Europe is 15%. So everybody has scrambled and found the different suppliers in different countries. I don't believe at 50% tariff it is feasible, because the consumer sentiment where it is, increase the price by 1.5 times and sell. So differential may be anywhere between 10 to 15%. Of that, how much we can capture is still yet to be seen.
Okay. And how much of our sales from jewelry also? Fine, I'll fall back.
Sorry to interrupt. Yes, please rejoin the queue.
Yeah.
Thank you. Our next question comes from the line of Rupesh Tatia from Long Equity Partners. Please go ahead, sir.
Yeah, thank you. Thank you for the opportunity. My first question actually is on Germany. Germany, I think growth rate is a bit of shocker. And I mean, is German market as big as UK? UK is roughly 950,000 crore market. Germany is maybe around 250 crore now. So if the German market is as big as UK, then the growth shouldn't plateau before, let's say 500, 600 crore sales. So what is happening? I think some more explanation would be very useful.
Sure. So Germany is internal, our own internal challenge in quarter, where we had our digital team was restructured, because some of the earlier players that we had, the overall e-com lead, the Meta marketer, the Google marketer, we changed everybody. So that disruption caused digital to reduce by 9%. We grew 6%. So digital should be growing much higher than TV, as you've seen in US and UK and as Germany was doing. But it is internal disruption that led to flat kind of growth. But we expect this growth to resume in this quarter and onwards.
So at least, I mean, Germany can grow at 20% kind of rate for next 2 years. That's like a fair assumption to make.
I can't say 20% or so, but I can say double digits. That is what our expectation is for this quarter and next.
Okay. And
or
then
maybe
Q3,
this year and next.
Okay. And then Q3, I think, is a very big quarter, obviously, seasonally adjusted. And unfortunately, in that quarter only, we have all this 50% tariff, this, that. Obviously, you found this casting solution. But do you feel, at least from your side, from supply side, are you like well prepared if the consumer demand holds and there would be, if the season is good in the US, festive season is good in the US, UK, everywhere, you would be able to capture a decent amount of market share from that. Do you feel confident?
Most definitely. We can confident as we ever have been in our ability to navigate any challenges that come our way. But we want to be conservative in our guidance and feed our guidance.
Okay. I have more. I'll come back in the queue. Yeah.
Thank you. Our next question comes from the line of Gaurav Nigam from Tunga Investments. Please go ahead.
Yeah, sir. two questions. First one is on this content and broadcasting expense. I think we had earlier guided that we will maintain like 18% or so percentage of revenue. I see that it is inching up almost every quarter now and ahead of the revenue growth. I mean, can you specify where are we investing and which geography specifically? And is there a revised guidance on this content and broadcasting expense?
So hi Gaurav, Nitin here. So the content broadcasting past financial year was roughly 19%, and we maintain, we because this was the area where we are investing most of the amount over here. The first two quarters is normally the lean quarter for the year, and the season is the biggest quarter of the year where we see the percentage terms this cost goes down. But we expect that this cost will be in the range of not this like this year in the range of 19%, and the major investment of this cost is going towards in our US market. As Sunil mentioned earlier, that our investment is in line mainly the gaming platforms like Eplavin, the OTT platforms of like Roku, and the Facebook marketing and the basic. So that is why the major investment is in US only.
And Nitin, just a quick follow-up on this. I think you used to measure the performance of the digital investment. Can you just highlight how it has been playing out over the last one and a half years since we started aggressively investing in digital? I heard about this Eplavin, like how it is playing out, because I think overall growth is still muted, right? So I mean, just give us a sense that how you're measuring it and whether it is giving you the desired result, in what metrics you are measuring it. Just give us a sense on that.
Sunil.
Yeah, let me take that. So we look at the customer lifetime, so the cost against the customer lifetime value. So when we started this about 2 years ago, we ramped up the investment. At that time, we were the cost of acquisition was it was taking a little over a year to cover the cost. So now that has come down to about between 6 to 9 months. Our aim is to bring that down to within 3 to 6 months of the acquisition of the customer. So as we bring it more between 3 to 6 months, we will further continue to expand the investment because we can recover the cost in a short period, and then subsequent period is where the cash flow comes from that customer. So it has progressively improved. And there are multiple platforms within digital. So within those, we invest some places or reduce some other places where we see the ROI being lower. So it's pretty dynamic, and our team watches it pretty closely on the day-to-day basis, and within the guidelines given, the ebb and flow of the investments made.
Understood, sir. And sir, the second question is on the overall market share. I mean, just give us a sense of in all the three geographies over the last 1 year, how has the market share trended for VGL entities versus the, I think, 4 or 5 competitor in each geography that we track?
Yeah, so we track it against the publicly listed companies. So earlier it was Curate Group and eWine. There is the Shop HQ. Now the Shop HQ are not in the business anymore, but when compared to Curate in Q1 also Q2 FY22, we were 3.1% market share. Now against this Curate, we are at 4.6% market share. So that is in 4 years. So we expanded our market share almost 50%. From 3.1% to 4.6%. Long way to go for us, long runway, but between these two listed entities. Now, if we look at the wider market that we see, US, UK, and Germany, we see there's a $30 billion worth of market which is addressable by us, which is TV-related shopping, and e-com/TV. So that size is about 30 billion. Of that, our market share is about 1.5% only. So there's a long runway for us to get into that total market addressable market size.
And sir, in the
just take it back. Yeah. It's about 20 billion. Of that, we are about 400 million So just about 2%.
Got it. And just quick follow-up, sir, on the...
Sorry to interrupt. Can you please rejoin?
Sorry, it was into the follow-up, if you don't mind.
Okay,
sir,
go ahead.
Just one quick question on both US and UK, where we are facing tariff issues and we have found ways to lessen the impact. I mean, just wondering, when we look at our competitor and when we have found ways, I mean, is this gives us some additional firepower in terms of gaining market share? I mean, what you would have seen in the last 2 quarters? I mean, just give us a sense that does it benefit us or we are in equal footing with compared to competitors? I mean, any sense on that would be helpful on the same market share point.
Definitely. So we believe that we have advantage over our immediate competitors. So none of them are vertical. So there's at least 1 or 2 hops before they get the advantage. And everybody else is not as agile as we are because we have our operations in US. If somebody else is there, they are not manufacturers in US. They're manufacturing in India or China or Thailand, and they're only reselling to other retailers in US, so they can't set up manufacturing. But they can get it done through third parties, and many people are doing that also. But we still are much advantageous than them. So there is a potential to gain the market share more, but there's also potential for consumer sentiment to be subdued in US, given the tariff, given the noise of inflation and some kind of immigration and all that. So that noise makes people cautious, and that we are being cautious in our guidance because we have to balance this advantage against the consumer sentiment.
Understood, sir. Thank you. Thank you. Appreciate your answers, sir. Thank you.
Thank you very much. Our next question comes from the line of Sahil Sharma from Dalmus Capital Management. Please go ahead.
Yeah, hi. Thank you for the opportunity. And I just wanted to understand within the B2B space, what would be the share of jewelry and lifestyle products? And B2B sales seem to be more consistent now. So how do you see this segment going ahead?
We don't know the share of the market size of B2B. It's pretty massive, and we never really mapped it because it was not as material for us. But given that there is China plus one.
Actually, I was asking within your B2B revenues, what would be the share of jewelry and lifestyle products? Or like
it's pretty much all jewelry.
Okay.
So our B2B is pretty much all jewelry or gemstone or jewelry. And we got advantage of China plus one that was there by US, UK, all those players. After India got 50% tariff, that slowed down a bit. But in longer run, I see that story to continue because once India is able to strike the deal with US government for this reduction, wherever India settle 15, 16, 17%, it will be so much better than China or even Thailand. So that story would be there, and I expect the B2B to be stable or slightly higher growth rate than B2C because of that story unfolding. And we benefit because of the scale, and we also learn about the market dynamics happening with other retailers. So it's a win-win for us as well as retailer.
Understood. And just trying to understand this, reduction in the time period for, covering the customer acquisition cost. So do you have, a breakup of digital sales directly from your own assets like website and apps, and the ones which are redirected from other channels and marketplaces?
Well, first, marketplace is minuscule. Amazon or Walmart are minuscule. So overall, for the whole year, we do less than $5 million of marketplace. So that is just about 1% of our revenue. The rest is all our own properties.
And how much of that now would be redirected versus say a year or two ago?
So actually, marketplace was a little higher earlier. It used to be 2-3% of our total sales. Now it's down to 1.5% of total sales. because our focus was to make it profitable. At Marketplace, we were not profitable earlier and on Amazon. Now we are profitable on Amazon, but we are not able to scale substantially up profitably in marketplaces. And secondly, we don't own that customer, so repeat purchase from that customer, lifetime value of that customer is non-existent for us. So we have to make money within the first purchase on that marketplace. And at that level, scaling is not as much easier as it is on our website, and that's where our attention is.
Okay, understood. And the last question was, actually, I was trying to understand within your own website or app, like how much of it would be, a customer coming directly to the website, and how much of it would be, redirection from, say, a Roku or, some other gaming platform, as you mentioned. So that's what I was trying to understand.
I understand. Oh, yeah, sure. So from Roku or Fire TV or gaming applications, all of those customers transact on our website only. We don't do transactions. There's no transaction platform on those. There's no checkout mechanism on those platforms. TikTok has it, but we don't do much business on TikTok. Amazon has it. Amazon, as I mentioned, we are less than 1.5% of our total sales on Amazon.
Okay. So actually, fine. Maybe I'll reconnect later on this. And on the LGDs, are our gross margins similar to the rest of the business, or are they lower or higher?
Yeah, they're slightly higher.
Okay, understood. Thank you so much.
Thank you. Ladies and gentlemen, we will take that as our last question for the day. I would now like to hand the conference over to Mr. Sunil Agarwal for the closing comments.
Thank you, everyone. I want to thank all the participants for your time and great questions. If you have any further questions, feel free to reach out to Prashant Saraswat at VGL or Amit Sharma at AdFactors PR India, and we'll be happy to answer your questions. Thank you all once again.
On behalf of Vaibhav Global Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.